Welcome back. Today was reported the GDP, gross domestic product, grew at a rate of 2.6% in the fourth quarter of 2022. This was revised down slightly from the prior estimate of 2.7%. Today's report, which is the final estimate for the year, for the last quarter, 2022, it did show household spending and business investment slowing as we approach the end of the year. Now, taking a look at a couple numbers, we look at the main GDP, gross domestic product, which again is the nominal value of all goods and services produced by the labor market in the U.S. The GDP per capita is the economic output per person. Household debt to GDP is a ratio that shows an amount of debt versus GDP per person within the U.S. economy. And then we also have the GDP-based recession indicator index, and this shows us the probability that the U.S. was in a recession during a particular quarter. Readings above 67 indicate the recession, and then after the recession has started, when the number falls back below 33, it's thought that the recession has ended. Taking a look at the first chart, purple line represents the S&P 500. This is going back to 2013. The red area chart shows us the GDP, and we can see a pretty strong relationship here as the GDP seems to be just walking up the stairs. So does the S&P 500. And when the GDP continues to rise, well, very simply, long-term investors may look for a dip on the stock market, and as long as the GDP continues to rise quarter over quarter, the stock market tends to follow. And of course, we had that very big turn down in 2020 when both GDP and the S&P 500 went down. Now you'll notice the theme that we're going to see here in a number of charts is there is a massive disconnect. As the S&P 500 at the end of 2021, early 2022, hit its high, the GDP kept on rising. But at the same time, the S&P 500 has really come back to the downside. So the question really is the stock market going to recover as the GDP continues to chug higher, or are we going to start to see signs of a slowdown in the GDP numbers? Now, of course, one of the major themes over the past year and the reason why the stock market has been so weak has been rising inflation. Now, the Federal Reserve, when they make their decisions to raise or lower interest rates, they look at GDP, they look at inflation and employment and these other macroeconomic forces. So, as investors and traders, we should do the same. The GDP looks good, at least on a long-term basis. The fact that the stock market is weak and has really diverged from this uptrend in GDP leads us to the next conclusion. Well, what do we think about employment? What do we think about inflation? Here's GDP per capita in the blue area chart. The yellow, again, is the S&P 500. Again, we had a very big downturn in 2021, and then since then, this has continued to chug higher. It's not as smooth of a trend higher, but still, nevertheless, it is moving higher on a quarter-over-quarter basis. Household debt to GDP continues to fall while the stock market moves higher. Of course, we had that very big downturn March, April of 2020, which coincided. There was a little bit of a lagging effect as we saw October 2020. We saw that the household debt rose as a percentage to or as relation to GDP, but that quickly turned back to the downside. If we start to see household debt return to the upside, that could weigh on the overall GDP number. Now, this does not take into consideration necessarily credit card debt, but there are other economic indicators that we're going to cover here that shows that credit card debt are at very, very high historic levels, and that certainly can affect consumer spending. GDP versus the federal funds rate. Again, as GDP continues to go higher, the Federal Reserve tends to raise interest rates. As GDP falls to the downside, interest rates are cut. We can see here that there was, 2020 was really a very unusual situation because all of a sudden the numbers turned bad and all of a sudden the Federal Reserve moved, and at the same time all of a sudden also the stock market went to the downside. So this is not typically how we see downturns transpire. But overall, again, there's a very strong correlation. And then finally, we have over here the GDP-based recession indicator index. This is very simply a mathematical calculation to determine the chances of a recession. If the number is above 67, which we did see this number hit highs near 100 back in 2020, that indicates a recession. Once this number hits 67 and then goes back below 33, then we see that it's believed that the recession is over. Now, more recently, this number actually hit highs. It looks to be right around 40, maybe a little bit below that. This was in February of last year. And remember, there were risks, there were concerns of a possible recession. But that has back below the 33% level. And of course, we did not hit the 67 level in February of last year. According to this indicator, we have to hit 67 in order for the real confirmation of a recession, which that did not occur. So, as we conclude with the GDP for the quarter, we ask ourselves a question. Is the stock market weakness an opportunity to buy with rising GDP? Because overall, as GDP goes up, so do stocks, historically speaking. Or is the stock market a leading indicator and leading us to an eventual turn down in GDP? Might be a case of buying the rumor, selling the news. To answer that question, I think it's wise to look at some of the other macroeconomic forces which go into shape our U.S. economy. For example, inflation and employment are probably the two major barometers that we use outside of GDP. So we have jobs numbers coming up shortly. We have some inflationary numbers coming up shortly, and we're going to try our best to identify those trends as well, so we can be, on the early side of catching the next move up in the stock market or preparing ourselves for a further downturn. We hope this has been helpful. We look forward to seeing you back soon.